Hi, Phil Greenwood from the University of Wisconsin-Madison School of Business. Next in our series of podcasts, we want to talk a little bit about return on invested capital in relation to return on equity, and especially the role of financing your company with debt and how that impacts return on equity. Recall our company, sales of $1 million, earnings after taxes of $100,000, paid some dividends. Note for this series, for this podcast, interest expense of $40,000 will come in to be very important for this, and also earnings after taxes and the income tax expense. Things to note: the income tax expense at $100,000 is roughly 1/2 of earnings before taxes, so it's about 50%. So we're going to have a tax rate of 50%. The interest expense we'll have to look at in relation to our debt on the books. So let's go to the balance sheet. Again, we're going to use 2014 as the year for analysis. Note in the liability and equity section that the short-term debt plus long-term debt is $550. The equity is $550. So that $40,000 in interest expense from the income statement is tied to the short-term and long-term debt of $550. So roughly about 8% interest expense. So what we want to do is show that return on equity has a series of components that if we take the several different ratios and split them up, we take return on equity and do what we call deconstructing, or literally split them apart, we can break it into components that can help us measure how return on equity is changing. In other words, what's driving it. So those components are profit margin times asset efficiency, which is pretty much our return on invested capital, pre-tax. That result times financial structure ratio and financial cost ratio, which we'll get into in a little bit. Financial cost ratio is just simply interest expense, the rate of interest we're paying on our debt. The financial structure is our debt to equity ratio, or a measurement similar to that. Then also equity is affected by taxes. So if we were to look at the specific ratios, you'd see that it would be EBIT divided by sales, that's our profit margin, times sales divided by invested capital, that's our asset efficiency. That result times invested capital divided by equity, which will be our financial structure ratio, times a ratio we'll call EBT divided by EBIT, earnings before taxes divided by earnings before interest and taxes. And that'll roughly show us the impact of interest expense, what that has on our profitability. Then those two products multiplied by each other times earnings after taxes divided by earnings before taxes, which will be our tax effect ratio. All three of those will be able to, all of those combined will be able to give us return on equity and give us a sense of, okay, what is causing return on equity to change? Now note, when we talk about return on equity and return on invested capital, especially if we talk about return on invested capital after taxes, meaning we don't use EBIT in the numerator, but we use earnings after taxes in the numerator, that return on equity and return on invested capital will be the same with ROE as ROE if we only use equity to finance the business, if there's no debt and no interest expense. However, most businesses use some kind of debt to finance their businesses, whether it's a line of credit, credit cards, whatever. Now we're gonna break down those components of the return on equity ratio that we saw early on and look at the financial cost ratio. The financial cost ratio, both of those, the numerator and denominator, come straight from the income statement. In other words, earnings before taxes divided by earnings before interest and taxes. So if a company has 100% equity, no debt, no interest, the financial cost ratio will be 1. That's as high as it can get. However, as we add more debt to the financing structure and substitute it for equity, then you can realize that the earnings before taxes will decline because we're having to pay interest expense. So in fact, the ratio will decline. The other component that affects return on equity that's related to financial structure or leverage is the financial structure ratio. So assume that assuming that the total amount of invested capital is the same, but if we use debt in place of equity, think of in return on equity, remember earnings after taxes divided by equity. As we substitute debt for equity, that lowers the amount of equity. It lowers the denominator in return on equity, so in fact, that will increase return on equity. Unless, of course, the interest we pay on it is a lot higher and it has that negative impact on income. So we want to look at what's the impact, what's the role of affecting ROE that having debt on the books, having more debt in relation to equity, what that impact is. The formula we'll use is investor capital divided by shareholders' equity. And remember, invested capital is debt plus equity. Finally, the third non-operational component that we want to look at that might affect ROE is to look at what role taxes have. In other words, the third variable that affects return on equity is taxation. In our original metric or original breakdown of ROE, we showed that ratio as EAT, earnings after taxes, divided by earnings before taxes. We can also break that down further. We can say, well, EAT is simply earnings before taxes times 1 minus the tax rate, that over EBT, canceling EBT out from the numerator and denominator. In effect, EAT divided by EBT is 1 minus the tax rate. So ROE can be affected by the taxes that we pay, especially when we include debt. So going back to our example company, the craft beer manufacturer, recall in 2014, you can see the earnings before taxes of $200, EBIT of $240. The difference between the top two is that we subtract $40,000 in interest expense from EBIT. Earnings after taxes is $100, so we're paying income taxes of $100 from the EBT of $200. The equity at the end of 2014 on the balance sheet was $550. Sales was $1 million. Debt was $550, so our debt to equity again was 1 to 1. The total invested capital, which is equity plus debt, $550 plus $550 gives us $1.1 million. If we insert those numbers into that ROE calculation, you'll see the simplified ROE formula. We get 18.2% ROE when we take earnings after taxes divided by equity. Break down to components, we can see that EBIT divided by sales, in other words, our operating margin as a percent of sales is 24%. Our asset efficiency, our sales divided by invested capital, is 91%. Our invested capital in relation to equity, in other words, our total debt plus equity in relation to equity, is 200%. So for each dollar of equity, we've got another dollar of debt financing it. So that ratio, the financial structure ratio, is 2 or 200%. Earnings before taxes divided by EBIT, our financial cost ratio, is 83.3%. Then our tax policy, our tax ratio, EAT divided by earnings before taxes, is 50%. Plug those numbers in, multiply the first two together, multiply the next two together, and then the result of the results of the top two and the next two, multiply those together, and then multiply that by the 50% tax rate. We then have an ROE of 18.2%. So now we have a mechanism so that as we look at return on equity, we can begin to say from year to year what's causing it to change. Is it due to higher profit margin, better asset efficiency management, or are we just financing with more debt in relation to equity, or are we bringing our interest expenses down? Or maybe simply the ROE is a higher ROE might be a result of better tax policy. In other words, we paid lower taxes in relation to prior years. The most important thing we want to get out of this type of metric and the decomposition or deconstruction of it is we want to ask ourselves, the goal is to improve ROE. How can we improve it? And by looking at all the components and how they relate to one another, that can give us a sense of setting some kind of operational and financial strategy that will help us maximize our return on equity, which is a really important ratio that shareholders look at, because they want to see, at least from a balance sheet income statement perspective, how good is management at generating profits based on the equity investment or the shareholder investment in the company.